Good afternoon, everybody. Welcome to this meeting of the MPC for March. Thank you all for being here. Since the previous meeting of the Monetary Policy Committee, the global economic environment remains challenging, notwithstanding some improvement in sentiment. Key factors affecting the environment include the possibility of an earlier than expected increase in the US policy rate in 2015, further evidence of a slowdown in China, and geopolitical tensions arising from the situation in Ukraine. The domestic economic outlook remains subdued amid continued strikes in the platinum sector and uncertainty regarding a stable and sufficient electricity supply in the coming months. While the most recent inflation forecasts suggest marginal improvements in the medium term, upside risks to the inflation outlook persist despite the recent appreciation of the rand, which remains vulnerable to shifts in global risk sentiment and adverse domestic developments. Together with downside risks to growth, this continues to pose a dilemma for monetary policy. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, measured 5.8% and 5.9% in January and February 2014, respectively, up from 5.4% in December. This marked upward trend was in line with the bank's forecasts. Food and non-alcoholic beverages price inflation reversed its previous downward trend, measuring 4.3% and 5.4% in the past 2 months, compared with a recent low of 3.5% in December. The contribution of this category to the overall CPI inflation increase was 0.8 percentage points in February, compared with 0.5 in December. The petrol price, which was the other main contributor to the higher CPI inflation in February, increased at a year-on-year rate of 14%. Core inflation, which excludes food, petrol and electricity, was unchanged at 5.3%, the 6th consecutive month at this level. This was despite upward pressures from exchange rate sensitive categories such as clothing and footwear and motor vehicle inflation, which were offset to some extent by a lower rate of increase in medical insurance costs. Administered price inflation, excluding petrol, measured 6.9%. The headline producer price inflation for final manufactured goods measured 7.7% in February, compared with 7.7% in January. The bank's forecast of headline inflation is unchanged for 2014 and is expected to average 6.3%, with a peak of 6.6% still expected in the fourth quarter. The forecast average inflation for 2015 declined from 6% previously to 5.8%, with inflation expected to average 5.6% in the final quarter of that year, compared with 5.9% previously. This improvement is mainly the result of the lagged effect of the repo rate increase. Inflation is still expected to breach the upper end of the target range in the second quarter of 2014 and to return to within the target range in the second quarter of 2015, when it is expected to measure 5.9%. The outlook for core inflation has improved and is expected to average 5.6% in both 2014 and 2015, compared with the previous forecast of 5.8 and 5.9% for these 2 years respectively. Notwithstanding this improvement, the upward pressures continue to be seen to be coming from the lagged effects of exchange rate depreciation. The MPC still assesses the risks to the inflation outlook to be skewed to the upside, as extended periods of overshooting of the exchange rate remain a possibility in the current uncertain global environment. There is also a risk that the current low level of pass-through may not persist. Inflation expectations as measured by the survey conducted by the BER in the first quarter of 2014 remained unchanged at an average of 6.1% for both 2014 and 2015, with inflation of 5.9% expected in 2016. Although the 2014 expectations of analysts increased to 6.1% from 5.6% in the previous survey, expectations of business people declined to 6.2% from 6.4%, with trade union expectations unchanged at 6.1%. Analysts expect inflation to moderate during the next 2 years to within the target range, while business and labor respondents expect inflation to remain steady at just over 6%, indicating that expectations continue to be relatively well anchored, albeit at the upper end of the target band. The Reuters survey of economic analysts conducted in March shows that inflation expectations of economists are more or less unchanged since the previous survey, and also remain, on average, anchored at the upper end of the band. The expectation is that inflation will breach the upper end of the target range in the third and fourth quarters of 2014 at an average rate of 6.1% before returning to within the target range. The global economic recovery continues to be uneven, with a first quarter slowdown in growth in the advanced economies compared with the fourth quarter of 2013, due in part to severe weather conditions, particularly in the United States. Nevertheless, the underlying U.S. growth prospects remain relatively favorable, despite a slower pace of employment growth, amid positive investment and consumption indicators. The UK economy continues to show signs of sustained improvement, with declining inflation and unemployment rates, as well as a buoyant housing market. The Eurozone growth prospects remain weak, although there are signs of a modest recovery, and the unemployment rate appears to have peaked. Japanese economic growth in the fourth quarter was lower than expected, and there are indications that the recovery could be losing momentum. The global outlook, however, is overshadowed by unfolding developments in the Ukraine and Russia regarding Crimea, although to date contagion effects have been limited to those countries with direct trade and financial links with the region. The other downside risk factor relates to a deteriorating outlook in a number of the larger emerging market economies, including Brazil, Russia, and China. Recent short-term data from China indicate that economic growth could decline below the government's target of 7.5%, at a time of increased risks in their banking sector. The slowdown in China is expected to maintain downward pressure on global commodity prices, particularly industrial commodities, while there are upside risks to some commodities, particularly oil and grains, from the tensions in the Crimea. Global inflation pressures remain benign, particularly in the advanced economies. Since the previous meeting of the MPC, the US has continued its steady path of tapering, although the financial markets now believe that the first interest rate increases may occur earlier in 2015 than previously expected. Over the same period, monetary policy has been tightened in New Zealand, Brazil, and Russia, and loosened in Israel, Thailand, Chile, and Hungary. The exchange rate of the rand has been relatively volatile since the previous meeting of the MPC, having fluctuated in a wide range between 11 Rand 39 and 10 Rand 60 against the US dollar. There has been an appreciating trend over this period, in line with an improving risk sentiment towards emerging markets. Since the previous meeting of the MPC, the rand has appreciated by about 2.4% against the US dollar and by 2.2% on a trade-weighted basis. While the risk to the inflation outlook from the exchange rate may have moderated somewhat since the previous meeting, these risks are still assessed to be on the upside. The MPC is of the view that the exchange rate will continue to be highly sensitive to both domestic and global developments, remaining prone to further bouts of volatility and protracted periods of overshooting. The current account of the balance of payments narrowed significantly from 6.4% of GDP, revised down from 6.8% previously, in the third quarter of 2013 to 5.1% of GDP in the following quarter, with a deficit for the year of 5.8%. The contraction of the trade account was a result of both a 3.6% decline in the value of merchandise imports and a 0.9% increase in export earnings. Although we expect the current account to respond to the depreciated exchange rate, this adjustment is likely to be gradual, and some widening of the trade deficit is expected in the first quarter of 2014. Constraining factors include the protracted nature of the strike in the platinum sector and the relatively inelastic import demand, particularly with respect to imported capital equipment. Promisingly, net exports made positive contributions to GDP growth in the final 2 quarters of 2013. Tapering by the US Fed and the expectation of US interest rate normalization continue to impact on the pattern of global capital flows and financial market volatility. The domestic yield curve flattened since the previous MPC meeting, as the short end increased in response to monetary tightening, while the long end of the curve shifted downwards. In contrast to emerging markets in general, South Africa experienced net inflows into the equity markets in February and March, totaling 11.6 billion, following net sales of 25.1 billion rand between November 2013 and January 2014. non-residents remained net sellers of bonds, but at a slower pace. Net sales of bonds amounted to 46 billion over the same 3-month period, but moderated to 1.2 billion in February, and net purchases of 2.1 billion in March to date. The domestic economic growth outlook remains subdued. Despite a rebound in the fourth quarter of 2013, when an annualized growth rate of 3.8% was recorded, economic growth is expected to remain below potential of between 3 and 3.5% in 2014, with a consequent widening output gap. The bank's forecast for economic growth has declined marginally to 2.6% in 2014, compared with 2.8% previously, while the forecast for 2015 has been revised down from 3.3% to 3.1%. The risks to this forecast are seen to be on the downside, given the protracted strike in the platinum sector and electricity supply constraints. This deterioration comes amid continued low levels of business confidence, with the RMB-BER Business Confidence Index declining to 41 index points in the first quarter of 2014, the fourth consecutive month at a level below the neutral 50 index points. The sideways movement of the composite leading business cycle indicator of the bank also points to a restrained outlook. The growth outcome in the fourth quarter of 2013 was led by strong growth in the manufacturing sector in particular, following the strike-induced contraction in the previous quarter. In January, a 2.5% year-on-year rate of growth in manufacturing output was recorded. According to the BER Manufacturing Survey, business confidence in the sector remains low despite increasing to 41 index points in the first quarter from 36 previously. There are, however, some positive signs in the sector, with the Kagiso PMI increasing to 51.7 index points in February, and the BER's indicators for manufacturing export sales and orders improving further in the first quarter of 2014 to their highest level in 10 years. Despite a strong performance in the fourth quarter, the outlook for the mining sector remains bleak. Mining output contracted at a month-on-month rate of 1.1% in January, and the ongoing strike in the platinum sector is likely to impact adversely on mining output and exports. Growth in real gross fixed capital formation accelerated to 4.7% in 2013, compared with 4.4% in the previous year. During the past year, real capital outlays by the private sector increased by 5.5%, while public corporations and general government investment increased by 3.1% and 3.5% respectively. Consistent with moderate economic growth, employment growth has remained weak. According to the quarterly employment statistics of Stats South Africa, employment levels in the formal, non-agricultural sector increased marginally at a seasonally adjusted rate of 0.2% in the fourth quarter of 2013, or by 5,100 employment opportunities. In the year to the fourth quarter of 2013, the increase was 0.5%, or 40,900 jobs, with the public sector contributing 39,000 of these jobs. Overall, private sector employment declined during the fourth quarter, with losses most pronounced in the gold mining, construction, and electricity sectors. The weakening trend in the growth in household consumption expenditure continued into the final quarter of 2013, with growth of 2% recorded, and its contribution to GDP growth declining from 2.3 percentage points in 2012 to 1.7 percentage points in 2013. Growth for the year averaged 2.6%, while consumption expenditure by general government averaged 2.4%. Household spending on durable goods remained firm, but grew at a slower pace of 6.9%, and is likely to moderate further as vehicle sales come under increasing pressure. Total domestic new vehicle sales declined in February by 2.6% on a month-to-month basis, and by 3.1% year-on-year. Although real retail trade sales exceeded market expectations in January, following a month-to-month increase of 0.8% and a 6.8% increase year-on-year, the outlook for consumption expenditure is expected to be constrained by slow employment growth, high debt levels of consumers, slow rates of growth in credit extension, and the higher interest rate environment. Growth in government consumption expenditure is expected to be contained. According to the recent budget, the expenditure cap has been maintained, and a consolidated budget deficit of 4% of GDP is estimated for 2014-15, in line with that of the past fiscal year. A faster pace of fiscal consolidation is indicated, with the deficit to GDP ratio expected to decline to 2.8% in 2016-17. Bank credit extension to the private sector has maintained its weak underlying trend, particularly with respect to credit extended to households, reinforcing expected pressures on household consumption expenditure. By contrast, credit extension to the corporate sector was relatively robust, with growth rates of around 10%. Although 12-month growth in total loans and advances to the private sector increased from 6.4% in December to 7.6% in January, credit extension to households increased by 5.5% and 5.6% in these 2 months respectively. This probably reflects both supply and demand side considerations. Mortgage lending remained weak, with 12-month growth of 2.1% in January, amid moderate house price growth. 12-month growth in general loans, mainly unsecured lending, to households continued its downward trend, measuring 5% in January, the lowest rate of growth since February 2005. Installment sale credit and leasing finance has remained buoyant, but growing at a more moderate pace, in line with declining vehicle sales. The trend in wage settlements has remained relatively unchanged. According to Andrew Levy employment publications, the overall average wage settlement rate in collective bargaining agreements measured 7.9% in 2013, compared with 7.6% in 2012. Data from Stats SA show that the growth in nominal remuneration per worker increased from 6.7% in the year to the third quarter of 2013 to 7% in the fourth quarter. Once the slight increase in productivity growth is accounted for, this translates into a unit labor cost increase of 5.2% in the fourth quarter. While this appears to be relatively contained, there are wide variations across sectors, and the outcome of wage negotiations during the year in an unsettled labor relations environment will be an important determinant of inflation pressures. As anticipated, the favorable trend of food prices in the Consumer Price Index has reversed, and pressures are expected on headline inflation from this source, despite the moderation of prices at the global level. Having reached a recent low of 3.5% in December 2013, consumer food price inflation increased to 4.3% and 5.6% in the subsequent 2 months. Final manufactured producer food price inflation accelerated to 7.6% in February, and further pressures are evident in the agricultural producer price inflation for cereals and other crops, which accelerated from minus 8.2% in August 2013 to 27.6% in February 2014. This contributed to the 7.4% increase in bread and cereal prices at the consumer price level in February. The wheat and maize prices reflect exchange rate pressures and domestic drought conditions. Although futures prices indicate some possible moderation in coming months following the recent rains, near-term pressures remain. International oil prices have been relatively unaffected by the Crimean crisis, and the price of Brent crude oil fluctuated between a relatively narrow range of US dollars 106 to 111 per barrel since the previous meeting. The exchange rate has been the main driver of the rand petrol price, which increased by a cumulative 75 cents per litre in February and March. The recent appreciation of the rand has resulted in a current over-recovery in the petrol price, and this is expected to offset, in part, the 20 cent per litre fuel levy increase, which is due to be implemented in April. The Monetary Policy Committee is acutely aware of the policy dilemma of rising inflation pressures in a subdued economic growth environment. Despite a marginal improvement in the medium-term inflation forecast, the trajectory remains uncomfortably close to the upper end of the target range. The main upside risk to the forecast continues to come from the exchange rate, which, despite the recent relative stability, remains vulnerable to global rebalancing. The expected normalization of monetary policy in advanced economies is unlikely to be linear or smooth, and the timing and pace is uncertain. The rand is also vulnerable to domestic idiosyncratic factors, including protracted work stoppages, electricity supply constraints, and the slow adjustment of the current account deficit. Pass-through from the exchange rate to prices has been relatively muted to date, but there is some evidence that it is accelerating. However, the forecast already incorporates a higher pass-through than has been experienced up to now. At the same time, the domestic economic outlook remains fragile, with the risks assessed to be on the downside. Demand pressures remain benign as consumption expenditure continues to slow amid weakening credit extension to households and high levels of household indebtedness. The upward trend in the core inflation forecast is assessed to reflect the exchange rate pressures rather than underlying demand pressures. Given the lags with which monetary policy operates, the MPC will continue to focus on the medium-term inflation trajectory. The committee is aware that too slow a pace of tightening could undermine inflation expectations and may require more aggressive tightening in the future. Consistent with our mandate, a fine balance is required to ensure that inflation is contained while minimizing the cost to output. The real policy rate is currently below what can be considered normal in the long run and is likely to increase over the medium term. The pace of tightening will depend on a number of factors, including projected inflation, inflation expectations, the state of the economy, as well as global developments. At this meeting, the MPC has decided to keep the repo rate unchanged at 5.5% per annum. We wish to reiterate, however, that even though we are in a tightening cycle, there will not necessarily be a change in the stance at every meeting, and that the increments may not always be of the same magnitude. Thank you, and I'm happy to take any questions that you may have. Miriam.
Thank you, Governor. Mary Misa for the Sunday Times. Two things. Was the decision unanimous? And everything you said seemed to imply that there will be further rate hikes. Can you confirm this?
On the first question, no, it was not unanimous. There were 4 people who felt that we should hold and 3 people who felt that we should raise rates. So it was not a unanimous decision. What is common to all, whether we agreed with raising rates or not, is that the common understanding of the challenges we face. There's no difference of outlook. It's a question of timing. It's a question of how we see that at this point in time. So it isn't a difference of assessment. It's a difference in relation to timing. And therefore, yes, we are indicating that interest rates are likely to rise.
With Reuters, Governor, what in your view is the biggest threat to your growth forecast at the moment right now? I mean, obviously I'm thinking of the platinum strike. But are there any other factors that are concerning you on the growth front? Thanks.
Well, I think there are a number of things. First of all, I mean, again, it's linked to what happens in the advanced economies, what is there in the markets, and that is improving. For us, it's also the question of constraints such as the electricity supply, the certainty, the reliability. That has to have an effect on decisions about investment growth opportunities, what advantages you take, as well as, if you look at it, what the outlook is in terms of new investments. So, you know, we have said very clearly that we are concerned about the relationships, and it's very important that we stabilize that as a country in terms of your employer-employee relationships around the workplace. And then I would think those are the 3 biggest ones: what's happening globally, what the markets are like, the labor relations, and the employer responses in that regard, as well as electricity supply constraints. Yes?
Hi, afternoon, Governor. It's Ntakis from Business Day. Just want to find out about when do you expect the rate cut implemented in January to start being felt in the economy, and through which channels are you hoping that the rate cuts will address rising inflation? Thanks.
Can I just, I think we raised rates, we didn't lower. So I'm sure that's what you meant. Yeah, we definitely raised rates in January. We did not lower them, just so that everybody's quite clear. We do not see reducing rates on the cards at this point in time. They can already see the numbers coming through, but perhaps one of my colleagues would like to address it. Rashad?
Thank you very much, Governor. Well, as you know, there's by now a pretty authoritative literature and experience that when you increase an interest rate, it's not immediate, it's normally in the medium term, and the medium term could be anywhere from 12 to 18 months. So I think I think we see the effect, particularly in 2015. That's not to underplay what happens in 2014. Your second question on channels, obviously, ultimately, there are a number of ways in which we think about this. The one critical way that was an important determinant of our decision-making was inflation expectations. We believe that the rate cut was quite important in signaling
rates cuts?
the rate increase. I'm just following you. The rate increase was quite. See what you started. Was quite important in signaling that we have strong resolve to manage inflation expectations. Naturally, the other ways, it must have some dampening effect on GDP, but it will have some positive effect on inflation, and that's the trade-off that is central to kind of monetary policy making.
Yes, Seppo.
Good afternoon, Governor. Do you have a level in terms of interest rates interest rate increase that the economy can handle?
No, we don't. We're not targeting a level of interest rates or the number of increases that there may be. We would, obviously, it's data dependent. We look at what is happening, what is the environment, and would take the steps that are necessary. But it's a question of not what the economy can handle in the sense that you say that, oh, well, the economy is fragile. And that's the trade-off that we're making. We're saying that we recognize that. And that's why our approach will be data. We will look at the data. We certainly see it as an interest rate raising cycle. How long that will last depends on the circumstance. We're dealing with a great deal of uncertainty. So it's not as if we're saying, look, if you go to X, then the economy can handle it. If you go to X plus 1, it can't. The challenge is that the economy is fragile, and therefore it is not simply a function of what the central bank can do. We're one tool in a range of tools that the country has, and it's for all of us to work together to ensure that we strengthen the growth side of the economy, and secondly, try to ensure that in our dealings, in our interactions, we make sure that the question of that we don't get into a wage price spiral that simply allows the effects of the depreciation to be annulled or not being really felt.
If I can just make a follow-up. You have indicated in your previous speech that we are unlikely to see the same level of rate increase that we've seen about in the past.
Not quite. What I said was that the past is not the best predictor of the future, and that the conditions where you had a rapid rise in interest rates previously was a very different environment. You had a significantly growing economy, credit extension was very high. So those factors determine also what your steps are and what the measures to be taken require. Right now we're seeing all of those very factors that affect some of the other countries do not affect us. We do not have, we've got relatively subdued private sector credit extension. We have not got some of the, we are struggling with growth. So it's a different environment and requires a different response.
Governor, a question from Danily Masea. You refer to the potential that rates could be adjusted by different increments. That is 25 basis points been spoken of before. Could you describe the circumstances under which tightening by 25 basis points hikes could be seen as more ideal than a 50 basis point hike? Thank you.
Look, that's a difficult question. What we're really indicating is that don't assume you're only moving 50 basis points. If your interest rates as they are at the moment, your rate at this level, a 25 basis point is still impactful. If you were at a much higher level where you've been before, a 25 basis point is not necessarily impactful. So all we're indicating is that don't assume that it's 25, 50, 75, or 100. It can move between the levels that you do. So that we had a 50 basis point, it doesn't automatically raise in January, doesn't automatically mean that it would be the steps that would automatically follow. At the lower level of interest rates, you have different options to be effective as well. And depending on what you're seeing, whether you want to raise one of the discussions, of course, and we indicate to that effect, is that some arguments put forward, not necessarily among the committee, but generally, you do a bigger amount up front and you then don't necessarily do higher amounts later. These are some of the things that people have to consider. What we would want to indicate is that we are dealing with an environment that is extremely uncertain. And central banks always deal with uncertainty. But your environment is uncertain, and therefore we will look at the conditions at each meeting and decide what the stance should be. What we are indicating clearly is that it is a cycle that is an upward trajectory of interest rates. Yes, sir.
Joe Brock at Reuters. I know you understand what you're saying about uncertainty, but at this stage, do you think it's likely there will be a rate rise at the next MPC meeting?
Depends what happens between now and then. Don't forget, and so to me, what we're saying is that it's not necessary at every meeting. It depends on what is happening, but it is that trajectory. Okay, so there should be no misunderstanding about that. But don't forget the decisions we're taking. Even if you take the January move, you're seeing an outcome or an effect of it towards the end of 2015 in the forecast. And therefore, when you look at all of these things, you've got to look at if we take that decision in May, what is the impact being? But it's not a short-term impact. So, we're trying to anticipate in a very uncertain environment. So I wouldn't say yes or no. I would say it'll depend on what we see. But we are saying that there will be interest rate increases.
Governor, a question from Joseph Mukena. Are we seeing any benefits coming through the weaker rand? Thank you.
Who would like to deal with it? Go for it, Kuben.
Thank you, Governor. Certainly, a weaker exchange rate has both costs and benefits for the economy. The costs are certainly in higher inflation, higher imported inflation, sometimes more expensive capital equipment and fuel. There are benefits in terms of supporting the export sectors. We've expected that exports would increase because of the weaker exchange rate, and I guess to a certain extent, the committee and policymakers in general have been a little disappointed at the pace at which it has increased. However, in the third and fourth quarter of 2013, net exports has started to make a more positive impact on GDP growth. In fact, it was a net positive. In particular, in the fourth quarter, we saw a fairly healthy rebound in the trade balance, and that's quite positive. There are certain indicators we mentioned in the statement. The BER manufacturing export orders index is at a 10-year high. So there are indicators that certain parts of the economy are beginning to benefit from the weaker exchange rate. But yes, it's too early to say whether there's been a generalized improvement or not.
Franz Wild from Bloomberg. You noted that the improvement in the unemployment rate was down to improved employment in the public sector. I think that's been a trend for a while now. Is there a concern that what effect this may have on the budget?
Would like to deal with that one? In the section?
Obviously, if you want to know on the impact on the budget, the people you must talk to are down the road. It's not so much us here. I think that what is of concern to us is the lack of growth in employment in the private sector. Government can only employ so many people. The biggest engine of employment creation should actually be the private sector. And I guess the fact that you are seeing that the growth in employment predominantly come from the public sector tells you that that might not be a very sustainable trajectory. You are aware that when the Minister of Finance tabled the budget, they also set an expenditure ceiling. So if they have set an expenditure ceiling, that suggests to you that government could only employ a certain number of people and not beyond that. And we've got no reason to second guess that the National Treasury will stick to the budget projections that they have actually put in place.
Why do you think the pass-through of the weaker exchange rate into inflation has been so muted so far, and why is it accelerating now?
Ryan, do you want to talk to them?
I think we suspect that the reason that we have had this relatively muted response has been because of the relatively weak state of the economy. Usually in the past, when we've had periods of exchange rate depreciation, the economy at times has been growing much faster. There's been stronger pricing power on the part of producers, etc. So there has been a fair amount of margin squeeze that has been taken place, and we estimate that the degree of pass-through has been significantly below what is in the forecasting model. However, there are signs in the latest CPI, for example, that the rate of pass-through is accelerating. If you look at the clothing and footwear categories and motor vehicles, you can see an acceleration coming through there. So it is something that we've expected could happen, but it has been quite muted for some time.
Ed?
Oh yeah, a follow-up again, Governor. I was just wondering, just on the topic of employment. I don't see any mention here. Sorry if I missed it, of wage settlements and inflation. And I was just wondering, do you see any moderation in that regard, and if so, why? Thanks.
I think Rashad can have, but it is in there. We look at the labour, the average settlement of 7.9, the question of what unit labour costs are if you take account. So it is there. I think just to add to the question around employment, obviously it's not just where the level of wages. It is level of wages plus what productivity is taking place. What is the efficiency of your labour force? I think the second question really has to be something that, if you look at trying to get to a virtuous circle, you need increased growth, which means you need increased confidence that there's investment, that there's employment that's taken on. So that is the environment that you need to work towards. And I think the issue of business and confidence is a critical one. I think the other question that there is, we've got to resolve the labour relations, and that's an employer and employee responsibility. So I think those are some of the challenges around that, but it is in the text. But I don't know if you want to add anything to that.
Yes, I guess Governor has answered it all. You know, we show in the text that average wage settlements measured at around 7.9% for 2013 and 7.6% for 2012. I think as the Governor said, you know, unit labor costs seem to be on a rising trend, and some of our kind of slow pressures that we see building in our forecast of inflation, you know, often has to do with kind of unit labor costs amongst other things, like the exchange rate and so on. But as the Governor said, you know, it's very hard to make sense of unit labor costs just at 1 quarter or 2 quarters. If unit labor costs rise with a commensurate rise in labor productivity, it is not necessarily the case that its impact on inflation will be direct, but it is the case that, you know, that unit labor costs is certainly amongst one of the factors that is responsible for the gradual upward pressure we're seeing in inflation.
Governor, a question from Peter Montalto. Governor, can you please go into more detail on your comments on market expectations of the Fed tightening coming earlier? You seem to imply these expectations are still far enough out with not enough effect on SA, yet for you to worry about. When do you get worried on that front? Thanks.
Peter, you should know by now that we worry all the time. The question around an earlier tightening is something that came out of the Fed's own press conference and communication. And markets certainly seem to be taking that on board, that is expected to be earlier in 2015. That is still a reasonable time away. I think that when I say reasonable, it's a question that has allowed, let's put it this way, the question up to now has been what is happening with tapering. Tapering is happening. The distinction being made is now having tapering being taking place, what would happen in relation to raising of rates, which is the normalization process. And we have spent a bit of time in the statement dealing with that, because we're saying we are concerned about normalization and its impact, and therefore we have said that it is a tightening cycle, because part of it will mean that the South African interest rates would also need to normalize. The challenge, of course, is what is normal. In an abnormal environment, what is normal? And that is part of the uncertainty that we have to deal with. So I would look at it in the sense of saying it's not about when do you worry. I would say that in terms of central banks at this point in time, we've been worrying for quite a few years. And we try to anticipate to the best that we can and take the measures necessary, which is what we're indicating that we will do.
Governor, you said there was a 4-3 split. Could you, those in favor of a hike, were they in favor of a 25 basis point or 50 basis point hike?
It was both. Some wanted 50 and some wanted 25.
How many?
No, come on, guys. It's not about, then you're going to say, well, is it likely that the proportionality or the probability of an interest rate being 25 basis points or 50 basis points, I'm saying to you that there were both views. And that has been the view before as well. So you take your pick as to what you anticipate. You must use your own judgment there, not ask me to help you. Okay, Miriam?
I believe you said in a recent interview that you didn't want positive interest rates. Is this still the case?
I would doubt that I've said that. I think I would have said is that even at this point in time, having raised rates by 50 basis points, real interest rates are still slightly negative. We're not looking at it to say whether they would be positive or negative. Obviously, it depends on where your inflation is and where your interest rates are as to whether they're going to be positive or negative. But for me, it wasn't about a preference. It was an indication that, notwithstanding that we'd raised rates by 50 basis points, real interest rates were still slightly negative. Anyone else? You're all fine. You sure? Thank you very much. Thanks, everybody from the MPC. Thanks, all of you who've come here. Thanks for the team and the work done. And we shall see you in May for further discussions about 25, 50, unanimity,